Have you ever wondered how some investors make big bucks without even buying stocks? Today we're diving into the world of stock options, a thrilling way to speculate on stock prices. Get ready to master the basics in just 10 easy steps. 1. What are options? Imagine you and a friend make a deal about buying a special toy. Instead of buying it right now, you both agree on a price today and decide whether you'll buy or sell it in 3 months. That's pretty much what options are in the world of trading. They are like promises between two traders. These promises are special contracts where you don't immediately buy or sell a stock. Instead, you agree now to make that trade at a future date and at a price that you lock in today. This setup is useful because it lets traders make plans based on what they think will happen in the market. For example, if you believe the price of a toy, or in this case a stock, will go up, you can set a deal to buy it at today's lower price. If your guess is right and the price goes up, you get a great deal. You buy it cheaper than everyone else. But if the price falls, you can decide not to buy it after all. And the most you lose is a small fee for making this deal. This fee is called a premium, and it's what the other trader gets in return for agreeing to sell at the set price later, no matter how high or low the market swings. 2. Understanding call and put options. In the world of stock trading, there are two basic kinds of options: call options and put options. Let's think of them as tools that traders use depending on their expectations about the future of a stock's price. For example, if you're positive about a stock like Tesla and believe its price will rise, you would buy a call option. This option gives you the right to buy Tesla shares at a price set today, no matter how high the price goes in the future. It's like securing a price now for something that could become more expensive later. On the other hand, if you think Tesla's price will fall, you would buy a put option. This option allows you to sell the stock at today's price, even if the market value drops dramatically later. Essentially, a put option is like having an insurance policy that lets you sell at a good price before it possibly gets worse. 3. The role of the option buyer and seller. In our example using Tesla stock, we meet two traders, Mr. Bull, the option buyer, and Mr. Bear, the option seller. Mr. Bull is optimistic about Tesla's future, thinking the price will rise. He buys a call option, giving him the right to purchase Tesla shares later at today's price. It's important to note that he's not obligated to buy. He simply holds the right to do so if it benefits him. Mr. Bear, on the other hand, believes Tesla's price will drop. By selling the call option to Mr. Bull, he commits to selling Tesla shares at the agreed price if Mr. Bull chooses to buy. Mr. Bear takes on this obligation because he expects to profit from the premium that Mr. Bull pays up front. This dynamic creates a balance of possibilities where Mr. Bull has the potential for profit if his prediction is correct, and Mr. Bear earns his premium while hoping the stock's price moves, as he expects. The exercise price. The exercise price in options trading is like setting a price today for buying or selling a stock in the future, no matter what happens in the market. For instance, let's say Mr. Bull and Mr. Bear are looking at Tesla stock. They agree on an exercise price of $165. This means Mr. Bull can buy Tesla shares for $165 anytime within the next 3 months. Now, if Tesla's stock price climbs to $190, Mr. Bull can still buy it at the much lower price of $165, making a tidy profit of $25 per share. This is because he locked in the lower price earlier with the option. It's like buying a concert ticket at an early bird rate before the prices go up. Because if the price goes up, you've got a great deal. If it goes down, you can decide not to buy the ticket, or in this case the stock, and only lose a small amount paid earlier. 5. Premium, the option's price tag. When you buy an option, whether it's a call or a put, you have to pay what's called a premium. Think of the premium like a booking fee you pay for concert tickets or a reservation at a fancy restaurant. It's the price for securing the right to buy or sell the stock at the exercise price later on. This premium isn't refunded even if you decide not to exercise your option to buy or sell the stock. It's the cost of entering the contract. For the seller, this premium is their reward for taking on the risk that the stock price could move against them. It's like getting a deposit. Whether or not the buyer uses the option, the seller keeps this fee. This system makes options a fair game. Buyers pay for the potential to secure a good price in the future, while sellers are compensated for their risk. 6. How premiums are calculated. The cost to buy an option, known as the premium, is not picked out of thin air. It is carefully calculated based on several important factors. First, there's how close the option's strike price is to the actual stock price at the moment. The strike price is like a target that the stock price might hit in the future. If it's very close to the current stock price, the option could be more valuable and therefore more expensive. Second, the time left until the option expires also plays a crucial role. The more time you have before the option expires, the more chances the stock has to reach the strike price, so the premium is higher. Lastly, the stock's expected price volatility, or how much its price is predicted to jump around, also affects the premium. Stocks that are expected to have big price changes cost more to gamble on because they offer a chance at higher profits. All these factors come together to set the premium price, balancing the risk and potential reward for both the buyer and the seller. 7. Profiting from options. Making money with options is like predicting the future of stock prices. If you guess right, the rewards can be huge compared to what you initially paid. For instance, if you buy a call option and the stock's price goes up past the strike price, you can buy the stock at the lower price and sell it at the current higher price, pocketing the difference as profit. The beauty of options is that they allow you to risk a relatively small amount, the premium, to control a lot more stock than you could otherwise afford. However, it's a double-edged sword, because if your prediction is wrong, the most you'll lose is the premium you paid. This makes options a powerful tool for those who are good at predicting market movements, but also limits the damage for those times when the market doesn't move as expected. It's like betting a little to win a lot, but you should always be prepared for the possibility of losing your bet. 8. The impact of leverage. Options trading is like using a lever to lift a heavy weight with less effort. In the financial world, leverage allows you to control a large amount of stock for a fraction of the price. This is possible because when you buy an option, you're not purchasing the stock itself, but the right to buy or sell it later at a set price. For a relatively small amount of money, the premium, you can control a lot of shares. This leverage can significantly increase your potential profits from small movements in the stock price. For example, if the stock price increases by just a few percent, the value of your option could double or more, making you a substantial profit on your initial investment. However, this also means that losses can be magnified. A small drop in stock price could drastically reduce the value of your option, potentially leading to a total loss of the premium paid. It's a powerful tool, but like any tool, it must be used wisely and with understanding of the risks involved. 9. Managing risks. When trading options, managing risks is critical. Smart traders practice risk management to protect themselves from big losses. They do this by only investing a small portion of their total funds in any single option trade. Think of it like not putting all your eggs in one basket. If one trade goes bad, it won't wipe out your entire trading account. Additionally, experienced traders set limits on how much they are willing to lose on a trade before they enter it. This is often done by setting a stop-loss order, which automatically sells the option if it reaches a certain price, thus limiting the trader's loss. Another strategy is diversification, spreading investments across different types of assets and trades, which can help balance the risk. The key is to keep potential losses small relative to the overall trading capital, ensuring that no single bad trade leads to a major financial setback. Managing risk effectively allows traders to stay in the game longer and increases the chance of making consistent profits over time. 10. Developing a trading system. To make consistent profits in options trading, it's essential to have a trading system. This system isn't just a set of random decisions. It's a well-thought-out plan that helps you decide when to buy and when to sell based on clear rules. Developing such a system requires a deep understanding of the market and its patterns. It involves analyzing past price movements, studying market trends, and understanding the factors that influence stock prices, such as economic indicators, company news, and market sentiment. A good trading system uses this analysis to create rules that help predict how prices will move in the future. For example, it might include rules based on technical indicators like moving averages or relative strength index, RSI, or it might rely on patterns found in the price history of a stock. Once these rules are set, they need to be tested. This is often done through a process called backtesting, where you apply your rules to historical data to see how well they would have worked in the past. By consistently applying these rules, you can make more informed decisions that aren't based on emotions or hunches. A reliable trading system aims to increase your chances of successful trades and can help manage risk by clearly defining when to enter and exit trades, thus maximizing potential profits while minimizing losses. Want to find out more about the basics of successful option trading? Then watch the following video. Options trading for beginners. The basics of calls and puts. Thanks for watching. Don't forget to hit the subscribe button to stay updated with our latest videos and learn more about mastering the markets. Make smart money. See you next time.